every Monday to Friday. This is Peter Lewis's Money Talk.
Money Talk.
Good morning. Welcome to a new week, Monday the 21st of August. This is Peter Lewis with Money Talk. You can find this programme on Substack, Apple Podcasts, Google Podcasts and Spotify. Just look for Peter Lewis's Money Talk, and that's also where you'll find us on Facebook, Instagram and Threads. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. And thank you for making us one of the most listened to financial podcasts in Hong Kong and Singapore, according to Pod Status. In today's business and finance headlines, China Evergrande Group has filed for bankruptcy protection in a US court as the world's most indebted developer works on a massive restructuring deal with its creditors. The company is seeking protection under Chapter 15 of the US Bankruptcy Code, which is for foreign companies seeking recognition of their restructuring in the US. The process will protect its US assets as it works on the restructuring of its more than $19 billion in offshore debts. The United States, Japan and South Korea have committed to consult on mutual threats posed by China and North Korea, conduct joint military exercises, hold annual summits and create new lines of communication. The Stronger Alliance, struck Friday at a landmark summit at Camp David, forms part of a network of partnerships that the US has created from India to Australia and Southeast Asia, and that the Biden administration hopes will alter the strategic landscape against China. China's securities regulator on Friday announced a package of market-friendly reforms to try and boost capital market investor confidence. The CSRC said on Friday that it was considering an extension to trading hours for the country's stock and bond markets and vowed to cut transaction fees for brokers. It also said it would encourage share buybacks to help stabilise stock prices. Separately, in a statement released on Sunday, the PBOC urged banks to increase lending to companies to bolster growth and stimulate consumption. On today's programme, I'm joined by Alex Wong, Director at Alex K.Y. Wong Asset Management, and Alvin Chua, Managing Partner of Mensa 360 Global Advisors. And providing a view on Mainland China will be China specialist and author Mark O'Neill. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
Volatility in the US Treasury markets that has pushed 10-year yields close to their highest point since 2007 weighed on US stocks last week. China growth and credit fears also negatively impacted sentiment. The S&P 500 was lower Friday by just 1 point, finishing at 4,370. The Dow added 26 points and was roughly 0.1% higher to close at 34,501. The Nasdaq Composite slipped 0.2%, ending the session at 13,291. For the week, the S&P 500 lost 2.1%. That's its biggest weekly loss since the collapse of Silicon Valley Bank in March. And all 11 S&P 500 sectors ended the week lower. The Dow lost 2.2% over the 5 sessions. That's its worst week since March. The Nasdaq Composite shed 2.6%, tumbling for a third consecutive losing week, a first since December. And last week, the 10-year US Treasury yield rose to its highest level since June 2008. However, yields eased from their highs on Friday, with the rate on the 10-year Treasury 5 basis points lower at 4.25%. For the week, Treasury yields were all higher, with yields rising the most at the long end. The 30-year yield was up 11 basis points at 4.38%, while the 10-year rose 9 basis points. The 2-year yield rose 5 basis points to 4.94%. And the effect of that was to steepen the yield curve even further, in other words, leaving it less inverted. In the currency markets, the Japanese yen staged a decent comeback versus the dollar on Friday. The dollar retreated 0.33% to 145.37 Japanese yen. Chinese authorities told state-owned banks to step up intervention in the currency market last week. The request came as the yuan fell towards 7.35 per dollar. That's heading for the weakest level since 2007. The People's Bank of China set its fixing just above 7.20 per dollar, compared to an average estimate of 7.30 and a half. And that was the largest gap to estimates since polls of banks were first conducted back in 2018. In onshore markets, the yuan fell 0.6% over the week to 7.28 renminbi, and for 2023 so far, the Chinese currency has dropped 5.6% against the dollar. Hong Kong's Hang Seng Index, that shed 376 points, or 2.1%, to end the day at 17,951. And for the week, the city's benchmark index plunged 5.9%, putting it in a technical bear market. Chinese tech stocks declined on Friday following weak earnings and pessimism over the country's economic prospects. The Hang Seng Tech Index fell 3.6%, taking its losses for the week to 6.2%. And the Hang Seng China Enterprises Index, which tracks the largest mainland companies listed in the city, fell 2.3%. And it's plunged 11% this month to become the worst performer among 92 global equity gauges. And looks like the Hang Seng's going to fall more further at the open this morning. Futures markets projecting a decline of about 150 points, putting it at just about 17,800 at the open. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
And on today's programme, we have two giants of the investment industry in Hong Kong. As always on a Monday morning, Alex Wong, director of Alex K.Y. Wong Asset Management. Morning, Alex.
Hi, morning, Peter.
And joining us also this morning, Alvin Chua, who is managing partner of Mensa 360 Global Advisors. Morning, Alvin.
Good morning, Peter.
Well, let's start with a couple of things that are really starting to weigh on the markets now. First of all, Treasury yields, and then secondly, China growth and credit fears. As we heard earlier, the 10-year Treasury yield risen to the highest point since 2007. I mean, Alex, the yields have been rising for a while, but it seems all of a sudden last week that the stock markets are starting to take notice of this. What's changed?
I think the change is that we are seeing the yield curve steepening on the demand from investors for higher risk premium on U.S. Treasuries, especially on the long end, because I think this is triggered by the downgrade by Fitch. This steepening actually is quite bearish, because we are having a real yield problem in the market right now, because inflation actually is decelerating, but the demand for higher risk premium actually would make the real yield higher. Because this is not caused by the higher inflation. Actually, it's caused by the demand for higher risk premium. So that means a bond more attractive in the long term. So, and also make stock less attractive, because right now you can get about 4% lock in 10-year Treasury right now, and those companies which are basing more on the future earnings actually will be discounted for less values right now. So that's why you are seeing ARKK down over probably 25% from the top in the last 2-3 weeks.
And how big a risk-off event is this likely to be then for markets?
I think at least we need to see some stabilization in the yield curve, and we also need the deceleration in the inflation to be faster, because right now the risk premium actually will stay there. So we probably need the inflation to come down more to make the base rate less decline, because right now I think people probably would still demand a high risk premium on U.S. Treasury, because I think Fitch actually make people realize that the current model may not be sustainable in the long term. U.S. actually would pay more interest because those are low coupon rates. Treasury actually will expire soon, and then will be replaced by higher coupon rates. So that means the federal deficit by the U.S. government actually would increase year by year from now, and then we are not seeing any real actions by the U.S. government to make the deficit less. So the long-term sustainability of the current model actually would be questionable. So I think people actually are aroused by the downgrade. So this is why the market reacts so much. I think this is a real yield problem, not just the yield problem right now.
Okay, so get it. So Alvin, how big a risk event do you think this is for the markets, for the stock markets in particular?
For the stock market, Peter, I think it's minimal. The more focus right now is on the U.S. Treasury yield, and I think it was brought by a number of factors. Remember, a few months ago, the U.S. Congress were debating on the debt ceiling increase. So the U.S. Treasury had been delaying issuing coming to the market with new issues. So now that the debt ceiling being raised and they're into the market on a combination of aggressive borrowing, funding the U.S. government, right? Secondly, we are the last few weeks witnessing a bear market flattening, i.e. the front end of the curve is not moving, staying steady, while the 10-year yield have been creeping higher. Now, a combination of reasons. One is the QE reversal, right? Since the 2 years ago, or since a year ago, the U.S. The Federal Reserve have been reversing the QE. Now they're not buying anymore on the long end of the curve. So it's been
they've sold about $1 trillion so far, haven't they?
Or let a trillion mature, right? So to speak. Now the Fitch downgrade a few weeks ago awoken what we so-called the bond market vigilantes, right? The U.S. government for the 2023 fiscal year is going to pay about $663 billion of interest expense in 2023. And that number is going to increase to 1.4 trillion 10 years from now, the way we are progressing. So now, a couple months ago, particularly with the collapse of the Silicon Valley Bank, the market was anticipating the Fed is going to cut rate by the end of this year. That has been pushed back. The Fed fund futures is pricing in the earliest possible May next year. And now, this past week, the market chatter has been, Fed may not be done yet. There is a possibility. Fed may actually hike rate one more time or a few more times before it's all over. Right now, with the U.S. growth, the Q3, the preliminary projection is 5.8%. At 5.8% and the historic low in unemployment rate, the Fed may not be done yet.
But if you look at the minutes of the last meeting that came out last week, there are signs there, aren't there, that Fed officials are getting more cautious about raising rates.
Exactly. The Fed may be, I think it's a split FOMC members. Right? Yes, they are getting more cautious, but it's data dependent, depending on what transpires over the next 2-3 months. Now, I personally believe the Fed was done on July 26th. But the market looking at inflation has receded a lot now with the headline inflation of 3.2%. That is very welcoming. But nevertheless, you look at historic unemployment rate, the energy price continues to be quite resilient, and the GDP growth. That has the bond market starting to worry.
But if you look at what's happening in terms of the soft landing, it looks like we may not even get any landing at all because the economy is starting to accelerate, isn't it? And if you look at the Atlanta Fed GDP now forecast, I think they were forecasting, 5.2% or something, which
5.8.
is 5.8%, yeah, which is just almost unbelievable, isn't it, for the US economy this quarter?
Exactly. Now the new buzzword is forget about soft landing. There is no landing.
Yeah.
Right? 5.8% is cruising speed, and that's not for US economy. It's more for China economy.
Is it realistic, Alex? I mean, 5.8%. I mean, surely we're not going to see that sort of growth in the US economy.
Of course, I think this is not what we will see in the long term. I think it's just probably just a short-term thing. I think I think, of course, U.S. economy is more resilient than we think. But in the long run, I think the higher yields actually would play a part. And also, I think in the meantime, probably people would question about the AI business model. So I think that this is another factor which we will see corrections, especially in the tech sector.
And we got Jackson Hole this week. The theme of that is structural shifts in the global economy. So maybe we might get some clues there from Jerome Powell when he talks on Friday about what this means for the Fed, and presumably that's going to be important for the bond market as well.
Oh, of course. I think we are in an era that the wealth is very polarized right now. So the wealthier actually is getting larger shares, and then we are also in the AI development right now. So I think that is deflationary in the long term. So right now the inflation factor actually is paid by certain parts, which may not be sustainable in the long term. So I think inflation will come down eventually. But in the meantime, what I've said, the real yield problem actually persists for a while. So I think this problem may not change.
But all we need, presumably, is one bad data print between now and, say, the end of the year, and everything changes again, doesn't it? Suddenly they'll be talking about how many more times the Fed has got to raise rates.
Yeah, I think the risk premium would remain there, so the yield curve probably would steepen. And the longer end actually probably would stay a little bit higher. I think the spread would stay. But the base rate actually would be variable. So I think that is why I said that the inflation needs to decelerate faster, because right now people are calling for a high risk premium.
But this bear steepening, Alex, that you're talking about for Alvin, that you're talking about for the yield curve, it doesn't have to be a problem, does it, for stocks, provided the outlook for corporate profits it also improves as well. But is it? Is that happening or not?
Exactly. It's not a major problem for the equity market. The tailwind from the economic growth must much make up for the higher interest rate. The new theme that emerged these 2 weeks will be interest rates will remain higher for longer. So even if the 10-year yield were to remain around 4.5% level, right, it's not going to do significant headwind to the economy. Now, there's structural change in the economy, right? The Fed rate hike from 0 to 5.25 have not had much impact on consumer spending. One would be, say, like in the mortgage rate in the U.S., right? 65% of the mortgage rate are below 4% or below. Now, you can hike rate to 5.25%. For people who already lock in 30-year mortgage at 4, below 4, 65% of the entire stock of mortgage loans in the U.S. below 4%. It's not make any dent on consumer spending.
Right.
Similarly, on the corporates who have locked in 10-year, 30-year money 2 years ago at the lowest interest rate possible in 2020, now at say like around 2%, 2.5%, the Fed can raise rate. It's not going to make significant impact for those corporates who have pre-funded themselves and lock in long-term cheap money. So I'm worried that if there's any mistake, that the policy mistake the Fed is going to make that would derail the economic growth, would be the policy mistake they hike too much. Right. Because there's a delay, significant, much longer delay effect from the policy impact from the Fed rate hike.
Which is what officials are most concerned about. It looks like that's their main concern at the moment now, that they just go too far and tip the economy into recession. But as I said earlier, the data's showing the opposite. It's not tipping into recession at all. It's actually accelerating. Yeah. Alex, the other big event that's going on, China. Particularly the woes in the property sector, which are now spreading to the financial sector and some of the shadow banking institutions. How much is that likely to be a global sort of credit event that could shake markets?
I think it will not spread into a global credit event, but the local market would remain bearish for a long term. I think for a long period. I would say because the property market actually is a bubble is already gone, and then we probably may see the aftermath right now. And I think the policies makers are using the old tools. They need the private enterprises to boost the economy. I have pointed out this many times here, because right now the economy is transforming, and if you are trying to boost the loan growth, actually people have nowhere to go, because you in the old model probably you lend to companies. They bought equipment and land and then to make money. But in the current in the new economy, they are borrowing money, or they're using money to get a higher user base, which are used on marketing expenses, which will be gone and nothing left, just some expenses. So I think this is very risky for lenders to boost lending to those companies with hopes. So you need companies like Alibaba or Tencent to do the investment, just like Microsoft to invest in OpenAI. So I think in China they are focusing too much on the old ways. So I think this is a wrong way to go. And private enterprises, those are just lying down because they are being regulated so much in the last 2 years. So I think the momentum is gone. So right now, that's why we are so bearish.
Is this turning into a liquidity crisis now that, it's been building for months, hasn't it? But are we seeing a sort of liquidity crisis, widespread liquidity crisis on the mainland?
Yeah, I think it's become a confidence crisis. And also, I think they are more concerned about what will happen in the medicine sector in the last 2 weeks. So in just short term, of course, we are not repeating the case of the education sector 2 years ago. But I think this also dampened the confidence in business. Because you know that if you do something, actually you will be risky for investigation. So I think that's why the whole China is lying down right now.
So this is why we've seen big falls in stocks like Alibaba Health and JD Health and so on.
Yeah, this is okay, because if you compare that with the education sector, which is down 50% overnight and then 90% over a period,
that's not going to come back. Is it?
This is not too much right now, but still, it is affecting the sentiment.
Alvin, what do you think? Is this China's Lehman's moment? Some people have been comparing it to that, haven't they?
Well, the property sector debacle in China is uniquely China. It have no meaningful, insignificant impact in terms of global economy. And I would not even name it as the Lehman moment. Lehman moment was an event that happened that triggered. The property sector in China, the bubble had burst 2 years ago and have continued to run down over the last 2 years, right? The 20 years of property bull market in China has ended, and now it's payback time. It's wealth destruction. So many people in China, and they're fanatical on owning properties, and also the property developer issuing offshore bonds. Unfortunately, the offshore bond, property sector offshore bond issued by the Chinese property developers, year to date as of last Friday, it declined by another 54%. And last year it declined 35%, and year before 37%. So I mean, like in terms of wealth destruction, this is this is astronomical from both actual ownership of properties in China, physical properties, ownership of equities, A share, H share, the shares listed in America, the ADRs, ownership of property developer bonds, these trust products, the wealth management product. And that now is cascading to a confidence crisis. The policymakers so far, what they're introducing is moving the needle. Right? People are not gonna buy properties if the mortgage rate is 1% lower. If the property price can decline 20% over the next 1 year.
Has the confidence just completely gone? Are people not buying properties at all, or are they buying them for maybe state-owned developers and avoiding the private developers? How bad is it in terms of demand for new housing on the?
In the case of properties, the confidence crisis is immense. Most people just stop buying, irregardless of who's the developer.
Why don't they buy in the secondary market instead? If they're worried about developers not finishing the projects and developing them, why not buy in the secondary market?
There are a lot of inventory in the secondary market. If you buy today, and if you can wait 2 months later, you may get it 20% cheaper. Why do you buy today? Nobody is going to catch a falling knife, right, so to speak, right? And if you're in tier 3, tier 4 city, there's no way you can even sell your properties. There's no taker. The tier 1 city, you're okay.
So, Alex, this is spreading, isn't it? Firms like Zhongrong, they've missed something like $14 million in payments, as we know of, to 3 Chinese-listed companies. Maybe there's plenty more that also haven't had payments as well. This is sort of becoming a financial issue as well, isn't it? Not just a property issue.
Yeah, I think that this becomes a vicious cycle. As I would point out, I think this is very difficult to get cash flow from property sales because this is a deflation expectation in the property market in China, and people could delay their buying decisions for a while. So I think that is making the cash flow problems in the developers more. So I think this would create some problems on the financial sector. But luckily, I think most banks are state-owned. So people still have confidence on their sustainability. But I think people would worry about the asset quality. So that's why they are trading so cheap. But I think the confidence will not be easy to come back because if China need to get out from this trouble, I think this would be transformation of the economy into a new economy. So I think the old economy part actually is dead.
And the new economy will be more consumption-led, presumably, and focus, as you say, on private companies investing, which sort of goes against what the government really wants to see, isn't it? It likes to have control, much more control of the economy itself.
Yeah, right now there's the problem because China doesn't want company to be so powerful, so that's why they want to limit their power. But the state-owned enterprises actually would not have those kind of execution ability to repeat the success of Tencent Alibaba. If China Mobile can be Tencent, I think it would become Tencent. It has become Tencent already 10 years ago, I think. So that's why right now we are having a problem in the old economic park and also in the new economic park. I think that they need to unleash the power of those scientific enterprises. But we are seeing Jack Ma is already gone, so people actually they are losing talent right now. So I think that is the real problem in China.
Alvin, what's the significance of the Evergrande bankruptcy in the US filing under Chapter 15? That doesn't make it bankrupt in China, of course, which is where all its assets are, but presumably it protects the assets in the US. But how significant is this?
In terms of the creditors in China, this is a insignificant event. Evergrande having liquidity crisis for more than 2 years, and this is a slow progress, the evolution, and finally it become a cross-border legal tussle, right? For the U.S. debt holders to protect their rights, with Evergrande filing Chapter 15 in America, right? The core is with the lack of confidence and properties are not selling, right? And the problem have mutated to some of the best, including say like Country Garden. Country Garden end of May last year was still rated investment grade Baa3 by Moody's. And look at what happened to Country Garden these 2 weeks. They are unable to pay their debt. Right. So, I mean, if you're a property developer, you are sitting on developed, finished properties, and you are unable to sell. God cannot help you. You require property developers. You develop and you dispose or you sell. In a deflationary environment we have right now, the property buyers are just holding off. And the lack of confidence and mutated to the consumer sector, the consumption you just mentioned, right? I mean, of course, the policy will be like to boost consumption, but where is consumption going to come from? The state-owned enterprise, they are reducing, they're cutting salary. The private enterprise are cutting workers. The youth unemployment is university graduates as escalating. So where is the consumption going to come from? That people are going to spend their money. Plus, you look at your bank account, right? And interest rate, deposit rates going lower. Your investment in stocks is losing money. Your investment in wealth management product is losing money. Your properties you own are losing money.
Not a good environment, is it?
Tremendous negative feedback loop for consumer confidence.
Now, Alex, two developments in the markets. First of all, the Chinese yuan, it hit 7.34 in offshore markets last week, close to a 15-month low. The PBOC now seems to be really pushing back against that, doesn't it? It's being very aggressive in trying to hold the yuan up. I'm wondering why. Wouldn't it be better for the Chinese economy if the yuan was weaker?
I think the yuan would be weaker later on. As I pointed out last week, I think that the depreciation would be slow, but I think it would depreciate. I think that they would manage depreciation, but they cannot change the trend. So as long as the depreciation is not that fast, because if they would be okay with that, because a lower one probably would be better for the economy longer term. But I think they are worried about that. A sudden huge depreciation would be disastrous, because many people probably would be unprepared. So I think they probably are trying to manage the depreciation speed only. Because if the yuan is 8 overnight, then I think a lot of people would be dead. So they probably would try to slow down the depreciation, but I don't think they would change the trend because the interest differential actually is negative.
Yeah,
for the yuan. Yeah, so I think the direction will not change. So we are going lower, but the speed will not be that fast.
Are there any signs of capital outflows? I mean, this is not the same as what we saw in 2015, is it, where there were big capital outflows, but nevertheless, any signs that they're picking up?
I think they will be controlled. So no huge sign right now, yeah.
Alvin, what are your thoughts on the Chinese yuan? I mean, it's heading for almost 7.35. It hit last week. Are you bearish as well, like Alex?
The Chinese yuan or renminbi, unlike every major currency, is not a convertible currency. It's not freely traded. It's what PBOC says, right? And PBOC had the balance between the importers and the exporters. The both sides of the economy is import and exports. A sharp depreciation of the renminbi would be devastating for the importer. Will bring in import inflation into China, although it may boost export. So it's not in the best interest of PBOC to induce or to allow a large, sharp depreciation of the renminbi. I agree with Alex totally on this point. Now, however, yes, I also agree that directionally, I think we are heading lower. Right? It's just over time. It's a managed, controlled depreciation. Now, in terms of capital flow is airtight. Now, right now, it's very, very difficult to transfer money out of China. However, there will be a small amount on and off, continuing going on. Now, and for foreign capital flow into China, I believe, unfortunately, it come to a standstill, right? Mm-hmm. So, I mean, net, I believe that, yes, in the longer run, we'll see gradual depreciation of the renminbi.
Okay, and Alex, what about stocks? The Hang Seng now in a bear market. The China Enterprises Index down over 11% so far just this month. So it's the worst performer out of 92 global sort of equity benchmarks. How much worse can it get?
I think from time to time we may get some technical rebound, but I think the overall trend is down, like renminbi. Because after the failed rebound last month, I think people confidence actually hurt more. So they are no passive buyer for long-term investing in China, I think, because in the long-term experience is so bad. We are back to the level 10 to 15 years ago. So that means you're underperforming the whole world for decades. If your MPF is in China, then you probably would feel very, very bad right now. So I think there's no passive money like the US to support the index overall. And then there are only speculators left. So people are betting on policies relief from time to time. But I've said the public policy relief actually is in the wrong direction. They are using the old ways. So the real benefit actually is limited. So I think the stock market will be going down. Actually, we are at 17 something right now, which is not too bad given the property market situation in China and the whole mess, I think. So we probably may see the market going down at a slow pace, but I think the direction is still down.
Alvin, what are your thoughts? Are you as bearish as Alex?
I'm almost as bearish, right? at this valuation level, it's enticing. However, now in the market, there's a saying that when something is cheap, it may stay cheap for quite a while. It may stay cheap for many years to come, right? Right now, the confidence in the equity market, both for domestic Chinese investors as well as Hong Kong local investors, the global investors, is a very low level. You look at Hang Seng Index from the year 2012 to the end of 2022, 10-year cumulative return, it was minus 12.69%. 10-year cumulative return. And they've been talk in the market that is a Chinese equity market resembling something we have seen before, the Nikkei 225, the Japanese equity market. Right?
Keeps getting compared to what's going on in Japan, doesn't it, at the beginning of the 90s?
Exactly. And that would shock anybody, right? I mean, the Nikkei 225 peak on December 29, 1989, Peter, that was 33 years ago.
I remember it well.
We are not even back to 38,000.
Never seen that again. Never.
Yeah.
How much, Alex, should global companies, US companies, be thinking about their earnings from China? Because obviously what happens in China is important for the rest of the world, isn't it? It's sort of inextricably linked to China. Are we going to see companies revising down their earnings forecasts because of what's happening on the mainland?
Yeah, of course. I think those who have more exposure in China probably would be revaluing the situation. But I think the good thing is we have a Middle East to coming back to compensate part of it. Right now, you can see the football market right now. The Middle East are so rich, I think.
They're buying every football player in the world, aren't they, at the moment? All the good ones.
They are paying 100 million for a year. So I think this is unbelievable. So I think people probably will be addressing the power of Middle East. So we are changing. I think people probably would be more Middle East oriented in their thinking right now. So I think that probably another revaluation that will be needed, because right now probably they need to devalue the exposure in China. But I think India or Middle East, I think would be new point for thinking. So I think global companies actually will have another growth point. So that probably compensating the loss in China.
Alvin, final word to you, the global impact of what's happening in China and in the markets.
For those American companies or global companies who derive significant part of revenue or sales from China, yes, they should start to worry a little bit, right? Not significant. It's not collapsing. It's just not growing. Okay, let's put it this way. It's not collapsing. It's growing. It's not growing, right? And with the sheer size of the scale of the consumption, 1.4 billion people, that is a huge market. You put the entire Middle East together, it's not even 70 million people. The largest country in Middle East, Saudi Arabia, is 34 million. Kuwait is 4 million. Qatar is 3 million, right? Something like that.
Yep.
Now, UAE is 7.5 million. And all of them combined, not even 5% of China.
Okay. All right. Well, interesting to hear your thoughts there. A lot going on. We'll be following this with great interest over the coming days and weeks. You heard that Alvin Chua, who is managing partner of Mensa 360 Global Advisors, and Alex Wong, director at Alex KY Wong Asset Management.
Peter Lewis's Money Talk.
I'm joined now by China specialist and author Mark O'Neill. Good morning, Mark, and thanks for coming in this morning.
Good morning. Thank you for the invitation.
Well, this morning we've been talking a lot about the property sector on the mainland and the woes in the property sector that are now spreading to the more broader financial sector. The big problem seems to be the government seems to be lost at the moment. It doesn't really seem to know what it needs to do to try and reverse this decline and stabilise the markets. How big a problem is it for the Chinese government?
Oh, it's a profound problem, because the economic miracle since 1980 has basically been fueled by what we call a virtuous cycle, which is the local government sell land, they use the money to build infrastructure, to build industrial zones, they attract companies, people move to the city to work in the companies, they need to buy homes, so they buy apartments, the prices of the apartments go up, the developers build more apartments, the land price goes up, the local government gets more money. Do you see how the cycle works? And this cycle, it's been a miracle. Nowhere in the world have house prices gone up so fast as in China since 1980. People who buy apartments have an asset that's increasing in value. The local governments have more and more money. They can build high-speed rail, wonderful new airports, expressways. They can improve the infrastructure. And so it's a wonderful way to improve the economy. Well, similar to Hong Kong, because Hong Kong relies on land sales too. But this has fueled this miracle of the last 30 years. And then what happened is that the developers built too many. We think 60, 70, some say 90 million empty apartments in China. And the new government under President Xi is a more, can I say, communist and more traditional Marxist government. And President Xi said, houses are for living, not for speculation. So I think quite rightly, he wanted to make houses more affordable for ordinary people. And he wanted to reduce the speculation and bring demand and supply more in balance. And then we had the COVID pandemic, which stopped everything. And then they issued this regulations about the 3 red lines, which you've spoken about often. And I think it's the combination of those 3 things. So many developers cannot meet the 3 lines criterion. So they have no more money, they can't go on building. And the demand has slumped. China's birth rate is now record low. The number of children is record low. So the basic demand is going down. And so we're now in this, we're sort of trapped now because this model doesn't function anymore. But it's very hard to see how the government can get out at this moment.
And for Chinese people, it's sort of frightened them, hasn't it? Because they are not used to seeing the value of their homes go down.
Well, yeah, since 1980, it's been an axiom in China. If you buy a property, your property will increase in value. That's not the case with stocks. It's not the case with other instruments, but that's been the case with property. So that belief, that religious belief almost, has fueled this property boom. And as we know, the property sector accounts for 25, perhaps 30% of the whole economy. So it's been a wonderful way to fuel the economy for so long. But this belief has now been broken. And then in addition, of course, there are many people who have paid for apartments and the apartments are not finished. And we've seen a lot of protests, people demanding their money back or demanding completion of the properties. And that's added to this loss of faith. So I think a lot of young people in China now, especially those who have no children, are saying, why buy? It's much more logical to rent. If you rent, the rents in China are generally modest, unless you're in a very big city. You have a much more comfortable life. You don't have this huge mortgage burden. And they see the stress of those who have the heavy mortgage. So that's another depressing factor for the market. So many young people don't want to buy anymore.
Why don't they buy in the secondary market instead? If they're worried about, these properties not being finished and not being delivered, why don't they go and buy in the secondary market where prices are cheaper and you don't have the same problem?
Well, of course, that's a good option. But we've been watching YouTubes by young, rather alternative Chinese. I can't say they're the mainstream. And what they say is we don't accept this model that you work 12 hours a day, you work 6 days a week, you have very little time for yourself, you borrow heavily to buy, even in the secondary market. You're a slave to your apartment. You're a slave to this pressure. And so many of these young people, they're trying to find alternatives to this lifestyle. And of course, the most important alternative is not to land yourself with a large mortgage.
That you can't repay for many years, and the value of the asset is going down.
Yeah.
So what is it then, if this model is broken, the financing model for these property developers is broken, we need a new model for them. What is it going to look like? Because we know what it's not going to be. It looks like the government isn't going to bail out these property developers. It seems absolutely adamant it's not going to do that.
No, I think President Xi, has quite a strong ideological line on this. For the traditional communist, the property developer is not necessarily a good man. I mean, he's a good man if he builds apartments for people to live in. That's good. But, many of the richest people in China are property developers. So, no, I think the line's been set. I don't think that can be changed. So, they've got to find other engines of growth. So one of them, for example, is green energy. Now, in this field, China has done remarkable success in terms of building solar power, wind power, developing electric vehicles. China is now the world leader in electric vehicles, in the lithium batteries that power these electric vehicles. The Chinese companies are soon going to move into the European market, and they aim to dominate the European market in electric vehicles. So that's a very promising sector to drive economic growth. But of course, it's much smaller than the property sector. It can only employ, hundreds of thousands of people, and in factories and distributors and exporters and so forth. Then we also have the China 2025 plan, which is that China be a world leader in advanced sectors, robotics, AI, aerospace, in other sectors. Again, these are all very promising. There's huge government investment in these sectors, and they're ones in which China is competitive at home and competitive abroad. But again, the numbers involved are not big enough, because the property model was wonderful, because it was a national model. You could do it in northeast China, you could do it in central China, you could do it in southwest China. You did it everywhere. Whereas these 10 sectors, they're quite specific, and of course they require highly skilled workers, which is not the majority.
So is this 40-year boom now over? I mean, the International Monetary Fund says China's growth is going to be below 4% now in the coming years. If you ask some of the private economists, like Capital Economics, they say growth is already 3% and it's going to fall to around 2% in 2030. This is going to damage, isn't it, Beijing, because it means that the objective set by President Xi of doubling the economy's size by 2035, that's not going to happen, and it's also going to make it much harder for China to overtake the US as the world's biggest economy, which has sort of been its long-standing ambition.
Yeah, I mean, I completely agree with those forecasts. I think the China boom, the China economic miracle has come to an end. And the annual growth we're going to see in the years ahead will be 4%, maybe even 2% in bad years. And so this is more sort of economically rational, and we hope it will lead to house prices which are easier for the majority of people to accept. But, China's still a country of 1.4 billion people. It's got to find jobs for 11.3 million graduates every year, plus all the million others who are leaving secondary school. So this is now, I would say, for the government, the number one headache. And that was why they wouldn't publish the figure for the youth unemployment, because it must be 22-23% now. Which
doesn't help foreign confidence, does it, in the markets? When you want to have transparent data, you're cancelling some of your important updates.
Well, I mean, all the foreign investors say now that in China, national security trumps the economy. So in the era of Hu Jintao or of Jiang Zemin, I think the leaders would have strived to put the economy first. GDP growth was the number one priority. But now, I think, under President Xi, I think national security, which is internal security, and its foreign security now are seen as more important than economy. So that makes the economic management much more difficult. And the best way to find work for people is, of course, the private sector. The private sector employs more people than the state sector, and it's more vigorous. I mean, it grows more rapidly. But there has been a very significant change. Of course, COVID was the main reason. Many companies were forced to shut because of COVID, and that wasn't the fault of the government. But many of these companies have not reopened again, and the ones that have reopened are not hiring as much as before. And the private companies are feeling that we're more like in the earlier era of communist rule, which is the state companies are very much favored and they have much better access to state credit, and state policies favor the state sector. And so private companies now are much more uneasy, and that means you don't want to borrow a lot to invest, you don't want to take on a lot of new employees. And again, I don't see how that's going to change, because I think that the official line is very clear.
How much of a risk is it that as the economy slows, it also undermines support for President Xi, the Chinese government overall, and then Beijing responds by becoming more repressive at home, more aggressive abroad, which then, of course, is going to raise the risks of conflict, isn't it, over things like Taiwan, for example? It seems that the economic slowdown is going to be linked to the political developments as well over the coming years.
Yes, I think so, and it's not good. But one of the things we learned in COVID was that the Chinese government has developed surveillance techniques which I think are unmatched in the world. I mean, Russia under Putin is an extreme dictatorship, but I think in technical matters they are years behind China. So I think Russia still uses the more old-fashioned methods, police and neighborhood committees and people reporting on their neighbors and, the old method to control people. Whereas, of course, as we saw in COVID, China now has extremely sophisticated ways to monitor people and follow people and know what they're doing. So I think the government, of course, is worried about social unrest and, discontent and so on. But I think they feel they have this techniques, they have the mechanism to be able to control it.
And you've been following China for a long time, haven't you? I think since about 1978, so more than 40 years now. I mean, how do the challenges that are being faced now by China compare with what you've seen over the past 40 plus years?
Well, I mean, we have to say that the China we see today is unrecognizable from the one that I saw, when I first went 1980 and then in the mid 1980s. I mean, we have to pay tribute to the extraordinary developments and sophistication that has come over these last 40 years. I mean, my first visit in 1980, I went to a restaurant with a British friend, and we sat in a restaurant eating meatballs, and there were about 60 Chinese, all in blue cotton outfits, above and below. You couldn't tell who was the man, who was the woman, because everyone had very short hair. And they all stared at us for the whole time we were having our dinner. It was not at all hostile. It was friendly, just very curious. And my Chinese then was very poor, but my friend spoke Chinese well, so she chatted to them. And it was as if we were on different planets. They had no idea who we were or where we came from or what we were doing. And, intensely curious, but ignorant. Worse. But now, of course, it's the other way around. I mean, Chinese are extremely elegantly dressed. They buy the most expensive consumer products. They buy Porsche and Lamborghini cars. They don't ride bicycles anymore. The world's changed upside down. And
you've written a lot of books about China over the years that you've been out, and Hong Kong as well, I should say, shouldn't you?
Yes, I've written 14 books actually, and China is an enormous subject. I mean, you could spend 100 years and you wouldn't finish writing.
And what's the latest one?
Well, the latest one is not so much about China. It's called Out of Ireland. It's about myself. It's my exploration of my Irish heritage. So we do have some chapters about China toward the end, and the final chapter is the Chinese in Ireland, which is also a very good story. I mean, about 10 years ago, the mayor of Dublin, Hazel Chua, is a Hong Kong lady. Her parents were legal migrants in Dublin, and they worked in a restaurant. They were cleaning dishes. And they met and fell in love, and they got married, and Hazel was their first child. And Hazel's mother is what we call a tiger mother. You know, she was very determined that her daughter would have a better life than she had. So Hazel was very good at school. She became a lawyer. She joined the Green Party, and then she was elected as mayor of Dublin. And she's the first ethnic Chinese to be the mayor of any major capital in the West. So it was a really landmark, and I think rather a praise for Irish people that they would accept an ethnic Chinese as the mayor.
And I mean, out of Ireland, it evokes people leaving Ireland to go elsewhere, and of course, Ireland has been one of the biggest countries in the world, hasn't it, for emigration over the years?
Well, the population of Ireland now is 7 million. Now, in 1841, it was 8.1 million. So the population now is lower than it was in 1841. So there's almost no country in the world where the population has gone down over the last 200 years. So the main reason is, yes, that the emigration has been so heavy. But one of the themes I want to bring out in the book is this has now changed. Well, China has had its economic miracle. Ireland has had its economic miracle too. And the GDP per capita of Ireland last year was double that of Britain. Now, when I was growing up, Ireland was a poor country, agricultural country. Maybe 70% of the secondary school children would emigrate. I mean, if someone had said that the per capita GDP of Ireland would surpass that of Britain, you would be laughed. You'd be thrown out of the pub. But Ireland has greatly developed in the last 30 years. And we were there in July. I was giving a book talk on the book, and the prosperity was quite astonishing. And the streets of Dublin, you could see Chinese, Arabs, Africans, Romanians, people from all over the EU. I mean, something one couldn't imagine, when I was a child, when the only people you saw in Ireland were Irish people and a few tourists.
Okay, well, Mark, thank you very much for coming in this morning. Very interesting to talk to you. We'll have to do that again soon. That's China specialist and author Mark O'Neill, and do take a look at his book, Out of Ireland.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening to Money Talk this morning. You can find more details about some of the topics I've been talking about today, along with information on other headlines and market moves in my daily newsletter. Take a look at peterlewismoneytalk.substack.com. I'll be back with another show tomorrow. Joining me then will be Asian fund management industry consultant Stuart Aldcroft, Jeff Howie, market strategist at the Singapore Exchange, and our US economics correspondent, writer and broadcaster Barry Wood. See you tomorrow.
Money Talk.